Good morning and welcome to another edition of the Ashworth Weekly Market Update webinar. We are glad that you're here with us today, and it's me back again, and we've been rotating through some of the principles of Ashworth and myself, and it's good to be able to share just a couple of thoughts with you today. So we're going to jump right in. Last week the Fed kept interest rates unchanged. It looks like that they don't know whether to call it a pause or a skip. They don't know whether. It's interesting. The markets right now are pricing in the fact that they anticipate that the Fed not having any more interest rate hikes, and their reasoning behind that is that up until this point in history, never has a Fed paused interest rates and then resumed hiking after that pause. So the market is interpreting this as a sign that the market is that the interest rates are going to stay where they're at for a little while until we get into another situation to where we need some more stimulus, and at that point, or we go into a recession or something of that sort, and then they're anticipating that interest rates will come down. But with that said, there is caution in the wind because we're not out of the woods yet. One of the things that we're going to show you with this chart is that because of the debt ceiling resolution that they passed here last week, the student loan debt repayment program or the debt relief program ends at the end of this month on June 30th. And there are about 44 million people right now that have student loans, about 1.6 trillion outstanding in those loans, and those loans will restart again here shortly. The average payment on those is anticipated to be about $250 per month. Now, for a lot of people, $250 per month isn't a lot of money, but if you look at the population of where this is currently sitting, the majority of the population is right in the younger population where that they tend to earn less, they tend to spend more in relation to how much they earn, they tend to have lower savings rate, and so this additional $250 per month could be a little bit of a bite to the system, just because those people may not be buying as much entertainment or other types of goods and services, clothing, and those types of things. So again, we're being cautious as we go forward. We do feel like that the markets are healing. It's going to take a while before they get back on track. One of the things that's interesting, as I've been reading through various economic commentaries and those types of things, is that if you take the top 10 tech companies, right now, those include Amazon and Nvidia and a number of those types of companies. They represent about 80% of the market gain that we've had so far this year. And those particular names or companies seem to be quite a bit overbought right now. Most of the talk behind the scenes with this is the Chat GPT and having these tech companies being able to take advantage of Chat GPT to help them drive more revenue through their portals and through their doors and through their servers. But they are quite inflated right now. But fortunately, there are still 80% of the marketplace that is still quite undervalued and needs to catch up. And so there are still value portions in the economy. There are still places where that we can earn a return off from these. We're going to have to be patient a little bit as we go forward. But anyway, good news, and we'll just keep watching and keep you in the loop as we go forward. Again, thank you for watching. And if you have friends, relatives, or others that you feel like may take advantage of this webinar, would be pleased if you would be able to forward the link to them so that they can also take advantage of this. With that, thank you so much, and we will see you in a while. Thanks.